This week's episode is brought to you by Crown Haven Wealth Advisors. Your retirement reimagined. Coming up today on RetireSHIELD TV.
So at its most basic level, a diagnostic is a stress test on your current portfolio and how well it's going to serve you in your retirement plan. So how we do this at our firm is we first established what our client really wants in retirement, and that's based on the qualitative aspects of their life. So what does retirement mean to them? What matters to them in their life in the first place? What do they enjoy doing? The reason retirement planning is so much different than financial planning is that you are at a completely different stage of your financial life than you were before. And so what I'm going to do is I'm going to show a typical portfolio that we see from a prospective client that comes into Crown Haven.
Okay.
So what we've got here is a big box firm, and we're using a third-party tool to analyze the risk and cost associated with this portfolio.
Knowing people and building trust. Get on the right path to achieve your retirement goals with Casey Marx and the team at Crown Haven Wealth Advisors. Understand the process and challenges of retirement planning. Discover the keys to a successful retirement.
Hello and welcome to RetireSHIELD TV. I'm Morgan Patrick, consumer advocate, and as always, I am joined by the founder and CEO of Crown Haven Wealth Advisors and creator of the RetireSHIELD process, Casey Marx. Casey is not only the author of Baby Boomer Retirement Bootcamp, he is also a retirement income certified professional as well as a certified financial fiduciary. It is good to see you, Casey.
Good to be with you, Morgan.
So today we are going to be discussing diagnostics in relation to retirement. So Casey, let's get into this. What is a diagnostic and why is it so important for a stress-free retirement?
So at its most basic level, a diagnostic is a stress test on your current portfolio and how well it's going to serve you in your retirement plan. So how we do this at our firm is we first established what our client really wants in retirement, and that's based on the qualitative aspects of their life. So what does retirement mean to them? What matters to them in their life in the first place? What do they enjoy doing? We gather all of this information during our relationship visit with our potential client. Then we run a stress test on that portfolio to determine what risk they're taking, what fees they might be paying, how it's going to work from an income standpoint, et cetera, to give them unprecedented optics on how well that's going to work. And it's very important to understand this as somebody who's approaching retirement or already in retirement, regardless of whether or not you're currently working with a financial advisor, because you're in a totally different stage of your life when you're entering retirement or in retirement. And that's called the distribution stage. So the reason retirement planning is so much different than financial planning is that you are at a completely different stage of your financial life than you were before. Most of us are used to what's called the accumulation stage.
Right.
And your money is growing, you're saving, you're investing, you're getting your income from employment or maybe some other sources. And if the market drops, it's not going to affect you in a material way. It might not feel very good, but you can kind of ride it out because of the fact that you are maintaining gainful employment, and you've got an income source coming to you from that rather.
Sure.
When you enter retirement, now you're at the top of the mountain. You've worked all of these years accumulating those assets, and now it's time for those assets to create income for you in retirement. That's called the distribution phase. Mm-hmm. There are very few specialists that really operate within this realm. And Crown Haven is one of the premier retirement planners in the nation doing this. So I want our viewers at home to imagine, for example, this is why it's so important to do a diagnostic, because this is essentially the sum total of all of the diagnostics. So I'm going to be giving you an average here of all of the diagnostics we've done over the past decade. Mm-hmm. And these are from all of the big box firms. So anybody you can think of, top 25, 30 companies out there that do investment management. So the average annualized return is 4.83%, which is a lot lower than what most people think it would be.
Okay.
The average cost to maintain that portfolio between advisory costs, transaction fees, mutual fund expenses, cash drag, all sorts of different costs add up to about 1.53% annually. The average maximum drawdown or potential loss that could happen on any given day in the marketplace is about 38.9%. So now for our viewers at home, you all have your own, different size portfolio, but I'm going to use a round number. And I want you to imagine, for an example, that you have a business and it's called Your Wealth Inc. And you're the CEO of that business. You own the company, and you've hired a chief financial officer, if you have an advisor, to manage that company for you. On an annualized basis, on average, the return is about $48,000. You're paying that chief financial officer, on average, about $15,000 to earn you that $48,000 return. And at any moment in time, you can wake up, get a phone call from that chief financial officer, or notice yourself that you've lost $389,000.
Wow.
So the question becomes, when you need that revenue in order to create the sustainability of your life, how long do you keep that business going?
It's not going to be around very long at all.
No, and you don't want to keep that business going. And I work with a lot of business owners who understand the importance of, having enough income to offset expenses, things of that nature. Well, it's the same thing for your retirement. And, folks are used to this concept of having enough money in their emergency funds when they're employed, so that if they get laid off, they can handle 6 months without a job. Very few financial advisors are talking about replacing income in retirement in a sustainable way. So this is why the diagnostic is so important, because you may not think right now that you need that income, but I promise you, you will get to a point in time when you need to rely upon that, whether or not that's inflation is outpacing, your buying power when it comes to defined benefits. Maybe you have a pension right now and that's good enough, or Social Security and that's good enough. But at some point in time, income will need to be generated. And when that happens, it's going to be very important that that's coming from a secure source.
Well, you used the term, the mountain.
Right.
And you plan, and a financial planner is going to get you or help you get to the top of that mountain.
That's the idea.
But then you have to get into retirement. You have to start coming down the mountain.
Yes.
And that's what the planning is for.
Yeah, and the goal, to kind of continue with the analogy, is to guide you down that path in a way where you get to enjoy all the views and enjoy it in a way that, you see fit, right? It's not, oh my gosh, I'm going to fall down the mountain. Oh my gosh, I'm going to hurt myself as I'm walking down this thing. We want it to be smooth. That's why I always say that, my job is to land the plane for my clients. And it's not that we're waving a white flag of surrender and we don't want to grow our money. We have ways to grow the money, but still preserve the money. Make sure that it's guaranteed to be safe, at least for the percentage of assets or proportion of the money that needs to be guaranteed to be safe, right? And it all comes back to the utility of the money. And what we do by doing that is it relieves so much stress in retirement, because I've never met a human being that wants to be managing their money themselves when they're 75.
Right.
Or managing an advisor when they're 75, calling them up and going, what are you doing to help me right now? Our clients, they're thrilled, because they know that they have an income plan that's on autopilot. They get to go and live their lives. They get to go and take a vacation in Florida if they want to. They get to go play rounds of golf at their bucket list places. They get to go visit their grandchildren across the country. They're totally fine, on top of all the basic expenses that they have, right?
Tell you folks, having a RetireSHIELD, being ready for your end game, it is key. So we're about to take a quick break, but if you want your own personalized RetireSHIELD plan or a free copy of Casey's book, Baby Boomer Retirement Bootcamp, make sure to call the number that is on your screen right now and talk with one of our representatives, or you can visit our website, RetireSHIELD.tv.
Do you know how much you're paying in fees or commissions with your current plan or advisor? What about unnecessary risk or future tax implications? Sit down with a fiduciary advisor at Crown Haven that can help you understand important concepts, and so you can make the best decisions for yourself moving forward. We may even be able to answer questions you didn't even know needed to be asked. Take advantage of our complimentary portfolio diagnostic by calling Casey and his team of fiduciary advisors at Crown Haven today.
Hello and welcome back to RetireSHIELD TV. I'm consumer advocate Morgan Patrick, and as always, I am joined by the founder and CEO of Crown Haven Wealth Advisors and creator of the RetireSHIELD process, Casey Marx. Casey is a retirement income certified professional as well as a certified financial fiduciary. Before the break, Casey, you were explaining what portfolio diagnostics are and why they are so very important to a stress-free retirement. Now, I know our viewers would love to hear more about this.
So we're going to do one better than that today, Morgan. I've got the laptop out. We're going to look under the hood a little bit. And so what I'm going to do is I'm going to show a typical portfolio that we see from a prospective client that comes into Crown Haven.
Okay.
So what we've got here is a big box firm, and we're using a third-party tool to analyze the risk and cost associated with this portfolio. So as you can see, this retirement account has $1 million. It's broadly diversified across emerging markets, mid-cap value, investment-grade bonds, the Standard & Poor's 500, value stocks, and government income. It's a well-diversified portfolio. First thing I want to draw our viewers' attentions to is this risk score at the top right-hand corner of the screen. 71. So what does that mean? Well, if you were to imagine a spectrum from 1 to 100, 1 is like you buried your money in the backyard and you've got armed guards.
Got it.
And 100, you're on a roulette wheel.
Wow.
So 71 is a pretty high risk score, but that doesn't tell us the whole story, right? It's the risk-adjusted return that we're looking for.
Okay.
It's going to give us a little bit more information down here. So 95% historical probability for this portfolio, and this is because this system knows the entire history of all of these funds.
Okay.
It knows over the next 6 months that you can either lose $153,000 or gain up to $200,000. Now that wouldn't be bad in an accumulation phase of your life because, like we said earlier, you're adding to this portfolio.
Right.
It's really bad though when we're talking about a distribution phase because you run into sequence of returns risk. So if you have $100, you lose 10%, you're down to 90. If you gain 10% on 90, you're not back to even yet. If you're taking money from that portfolio as you're doing that, it makes it a lot more difficult, right?
Got it.
So, the annual range midpoint or average return for this portfolio is 4.77%. A lot of people are really surprised when we show them these types of figures based on the data. They think their return can be much better than this.
Okay.
But this is the fact. The expense ratio, which is the cost for the mutual funds these folks are in, 0.72%. The advisory costs and transaction fees, etc., are about 1.4%. So we're paying over 2% for this portfolio to get us a return of 4.77%. If we go a little deeper and we look inside, say, the mid-cap value fund, it's going to have its own risk score. So each individual security we're able to do an in-depth analysis on. Its worst case scenario here, 22%, best case 29, return 3.44. Its expense ratio is 0.59%. So what this system does is it takes all these securities and brings them up to the top here and tells us our portfolio result.
Got it.
So here's why it matters. If we do a stress test on this portfolio and we say, okay, what would happen in different types of market environments?
Okay.
And we compare that against the Standard & Poor's 500, which is the most broadly watched and measured index in our country. Well, if a 2013 bull market were to happen again, the market were just awesome, and your money were invested only in the Standard & Poor's 500, you'd earn 32.3%, $323,000. With this diversified portfolio, you're going to earn $209,000. And this is why diversification cuts both ways, right? And I think people understand this on a gut level, but they don't really know the data of it. So, and this is also why it's disingenuous when folks that only manage money and charge a fee say, you know, folks that use the bucket number 2 items, those won't give you all of the upside in the market, because these won't either. The difference is bucket number 3 also has a lot of downside, which I'm about to show you.
Okay.
So let's look at a bear market. If a bear market were to occur, the reason people don't put all their money in the S&P 500 is because if it drops, they lose 37%.
Yes.
But when you're diversified, you still lose a pretty devastating amount, $267,000. Now, if a financial crisis were to happen, you're losing $395,000 out of your $1 million portfolio. So this gets back to our examples we've been giving in the past. How long would you keep that business going?
Not long at all.
So here's why it matters though, because now we're in a distribution phase. So I'm going to show you some data down here. This is the same portfolio. $1 million has been invested. You want to retire in 2030, let's say. You're not even retired yet.
Okay.
And then at the age of, or at the date of 2030, you want to take a $4,000 monthly withdrawal. You want to use the 4% withdrawal rule. We plan for you to live to age 95. Why? Because we want to have a plan for life, not a plan for death. We're going to have to put the 105-year historical average of inflation in here,
Okay.
right? Because there's going to be periods of very high inflation, periods of very low inflation.
Okay.
If we do that, this is the probability of success in retirement. You have a 60% probability of this portfolio working. It's not a very good shot. And for our viewers at home, what this shaded area means, this is your area of dispersion. So, you know, worst case scenario, you're out of money in 2045 with this strategy. Best case scenario, you've got the same $1 million at the end of the day, but more than likely, you're just going to steadily decline over time. And what does this translate to from a human standpoint? You're stressed the entire way, and there's complete uncertainty along that path. So here's how we solve it with our 3-bucket approach at Crown Haven.
Okay.
So you'll notice right away that the risk score is a 23. We like to see our clients between 1 and 30. Why? Because we're in a distribution phase. The annual range midpoint is 7.91%, and the costs have come way down. Why is that? Well, we've used 3 buckets. Instead of having everything in bucket number 3 being charged a fee and at risk, we've actually located the assets properly for this human being. So now we look at what those buckets are. Secure income bucket, this is bucket number 2. $600,000 of this portfolio is allocated here. What is it going to do for you? It's never going to go backwards due to market losses. Its upside might not hit home runs, but it's going to average maybe 6, 7, or 8%.
Right.
That gives you the risk capacity to have $300,000 in the market, right? And this is going to be completely customized for each individual. This is obviously just a model portfolio to show the philosophy. But let's say you've got $300,000 in the market. You're still going to want to have emergency funds, $100,000 in savings. With this strategy, it results in this result. 7.91% annualized return, costs are way down, and now, over the next 6 months, there's a 95% historical probability of your downside only being $24,000 with an upside of $103,000. It's an amazing shift. So now when we stress test this portfolio, here's a bear market. Your downside is literally 1%. If a financial crisis were to happen, you're down 32 grand. Now, nobody wants to lose $32,000, but $32,000 is a far cry from $395,000. And there are different purposes of money, right?
Right.
So we want to have liquidity. That means we don't put all of our money in bucket number 2. So this is liquidity. For tax advantages, things of that nature, we'll still use a bucket number 3, right? We don't abandon any one tool, we just use them properly together. So this is how it changes people's lives.
I mean, it's just a wonderful illustration. With that, we are about to take a quick break, but before we do, want to remind you to join the thousands of Hoosiers that have already shielded their retirement with a personalized RetireSHIELD plan. Our lines are always open, so call the number that's on your screen to talk to one of our representatives to find out more about it and to get signed up, or visit our website, RetireSHIELD.tv, for your own personalized RetireSHIELD plan or a free copy of Casey's book, Baby Boomer Retirement Boot Camp.
You deserve a secure, independent retirement. A retirement that is prepared to handle pitfalls like inflation, health emergencies, stock market volatility, and taxation. You've worked hard for your money, and the team at Crown Haven will work just as hard. Take advantage of your complimentary relationship visit by calling Casey Marx and the team at Crown Haven today.
Do you hear that? That's me enjoying my retirement, traveling around the world to play golf where I want, when I want, with whomever I want. because years ago, I rolled over my IRA with the help of the local independent and trusted fiduciary team of advisors at Crown Haven.
Hello, and welcome back to RetireSHIELD TV. I'm consumer advocate Morgan Patrick, and as always, I am joined by the founder and CEO of Crown Haven Wealth Advisors and creator of the RetireSHIELD process, Casey Marx. Casey is a retirement income certified professional as well as a certified financial fiduciary. So Casey, earlier in the program, you mentioned portfolio diagnostics and how they are absolutely crucial for a comfortable retirement.
Yeah, so just to kind of review what we talked about in the previous segment, if we look at a stress test for a portfolio that we typically look at when somebody comes in to learn about our services, if a financial crisis occurs, our typical client is looking at a loss of about $395,000 on $1 million portfolio.
Wow.
As a result of what we do for our clients, the loss turns into about $32,000, right? So we've reduced that downside significantly. So here's why it matters. Because for 99.9% of all investors, the purpose of investing is for income later. So now let's look at that same income map we showed from before. So this was the previous portfolio, 60% probability of it working with a worst case scenario of running out of money in 2045. $1 million investment, retirement year 2030, monthly withdrawal $4,000, inflation rate 3.1%, etc. All I'm going to do is shift to the portfolio that we created. And look at how that changes.
Dramatic.
It's amazing. And this translates to the human component, which is this entire pathway now, you have certainty of outcome. And this is where my job gets fun. Because now what I can do is I can help people plan for a retirement that they want to enjoy. We can start planning in additional withdrawals to take bucket list trips. If they want to take a cruise down the Danube, if they want to go play their favorite golf courses, the destinations that they want to hit, if they want to visit their grandchildren on an annualized basis, whatever they want to do, we can build this into the plan because we know it's not going to break. And that's one of the most beautiful things about what I'm able to do on a daily basis.
What's the reaction when you're going over the data? Because that's what is most intimidating for most folks.
Well, I'll tell you, when we get to this stage with the client, they sit back in their chair and they're just in awe. It's like, here we go, we can do this.
Right.
Right? I've had people cry. I've had wives look at husbands and go, we're going to be okay. Right? It's a touching moment to be able to show people the data and they know that they're going to be all right. It's truly amazing to be part of somebody's life in that way. And you know how unique you are in the field when you're doing that on a daily basis, because you realize that there aren't very many people out there that are providing folks this type of peace of mind. But while we have folks looking at the data on the television, I want to show them some other portfolios and what those would look like too, because I'm sure they're curious.
Yeah.
So, you know, this is our portfolio and this is the kind of certainty that gives you. But some folks might ask, well, what does a perfectly balanced portfolio look like, assuming there's no cost associated with it? Okay. So let's say I've got my favorite broker dealer and I've balanced it perfectly. I am perfect. 50-50 stock bond allocation.
All right, you're spot on.
Well, this would actually be 55% stocks, 45% bonds, but we're close enough. It would give you a 91% probability of success. So this is the trade-off. So this is perfectly balanced, no cost associated with it, with risk, okay? And you'll see all the dispersion that exists here. So this is the uncertainty. So what this is going to require in your retirement is to get this at no cost, is you managing it yourself and not doing what? All the things that you want to be doing.
Right.
It's waking up every morning, looking at the financial news.
Grinding.
Stressing. Exactly. That's what this looks like. Okay? So this is why we see a lot of folks with their advisors paying a fee, 25% stocks, 75% bonds, and that's what this looks like. Now this is really bad when you're paying somebody 1% to have you here. Now what I want to make clear is that this is showing it without a fee. Okay? So this would be like perfectly balanced, 25% stocks, 75% bonds, trying to take that type of withdrawal. It just doesn't work.
Got it.
This is why we see a lot of folks come in and they're just super high equities. And then this can give you a shot. And this is the Kool-Aid that all of the asset under management folks and their advisors that want to keep them in bucket number 3 have been drinking. And they're telling them, hey, I'm going to charge you this 1%. I'm going to make the trades on your behalf. We're going to do this absolutely perfectly. But I don't know if it's easy to see on television, but this gray area, it goes all the way back to about the same spot that you would have had if it were a perfectly balanced portfolio with no cost doing it yourself. So you're really not getting much added value, and this is significantly higher stress than having it balanced perfectly doing it yourself. So the choice is, do you do it yourself, manage it with all of your own time and energy, and worry about that?
Right.
Do you take much greater risk and pay somebody else to do that for you and then manage that human being to maybe give you a shot? Or do you simply use tools that exist in a well-balanced way that do this? This is why we've built our planning process the way we built our planning process, because quite frankly, as advisors, it feels tremendous to sit in our office and know that when a COVID happens, when a 2022 happens, when a great recession happens, when the banking crisis happens at Silicon Valley Bank, our clients are okay, and we know they're okay, and it's based on data.
You can land the plane.
We can land the plane. Not only are we going to land the plane, but we're going to be able to take off the plane a couple of times, go to different places in a literal sense, right? Enjoy ourselves.
Right.
And we're going to be there to watch them enjoy themselves too. And that's the most fun of my job, is to really watch all these folks do those things.
I mean, in an uncertain time, and that's where we are. I mean, just to have certainty. That's what people want.
Well, and it's going to sound cliche, but we're the port in the storm. That's how we view ourselves. There's so much we don't have control over in the world right now. And, you know, it's like you've got your health. You want to be paying attention to that.
Yeah.
You've got your finances, right? You've got your relationships. Those are all extremely important, right?
Right.
If we can help people find ease of mind when it comes to their finances, we find, and this is data dependent as well, and there have been studies done on this, if your finances are in good shape and there's not stress there, then it allows you to focus more on your health, your relationships. It allows you to live a better life. So this is not just, we're talking about numbers here. This is talking about enjoyment of life.
Well, that being said, our time is up for today. We'll be back next week. But if you are looking for peace of mind in your retirement, do not wait. Remember, our lines are open 24/7. So call the number on your screen right now. You can also go to RetireSHIELD.tv for your free copy of Casey's book, Baby Boomer Retirement Boot Camp, or to have a personalized RetireSHIELD plan created for you by Casey and his all-star team of financial advisors.